A lot of you guys, even though you have an idea of what an order block is, you still struggle in picking the correct order block. And that's not to be blamed, because simply order blocks appear everywhere within the markets. But your job as a trader is to be able to identify the high probability order blocks and trade off of those. So let's begin with what order block is. If you look at this bullish scenario over here, where we had this market reversal, your last down candle before you had that displacement higher becomes your bullish order block. Here, this is where you would mark out your order block. Now, ideally, if price comes back to this order block, all it is simply doing is accumulating more positions before distributing price higher, because here you had already had your market reversal, and a bullish order block gets created in the process of doing so. Remember, it's your last down candle before the up move. Vice versa for a bearish scenario. Here, you had a bearish market reversal. The last up candle before the down move to take out this swing low, creating your market reversal, that becomes your bearish order. Ideally, when price comes back into here, it should accumulate more short positions before distributing lower, because you had already had your market reversal here. So that's the basic of an order block, right? It's fairly simple. Here, this is where you could get another order block. When price gives you that market reversal and it retraces into some sort of a premium array, or even a bearish order block over here like we had, but let's just assume that it retraces back into any premium array over here. When that gets created and it has another break lower, this is where you get your mitigation block. Now, even though it is called a mitigation block, it is still a form of an order block. So for this video, I would just be categorizing them as your order block. A lot of the times, when price retraces after it gives you that initial market reversal, from here to here, there will be multiple consecutive up candles. This is where you could use the entire range as your overall bearish order block. If you want to refine it, you could only use a select number of consecutive up candles, but in scenarios where you have multiple consecutive candles, you could use the entire range that covers the multiple consecutive candles, right? Because essentially, on the higher time frame, that is just one large bearish order block in this bearish scenario. So assuming here you had your multiple consecutive up candles, when price has a full body closure past the open of your first up candle that started this consecutive range, that is where it would validate your bearish order block. Same thing for up here. Imagine here, you only had one up candle, and that one up candle was your last up candle before the move lower to give you that market reversal. When price has a full body closure past your last up candle's opening with a full body closure, that now validates this bearish order block. So that is the basic of order blocks. I'm sure a lot of you guys are aware of what order blocks is by now. So now let's focus on your high probability order blocks, right? If you look at this example here, this entire segment in price, how many bullish and bearish order blocks could you identify? A lot, right? They literally appear everywhere. Not only that, but even in this bullish scenario, even though it's hindsight, you can see that there are bearish order blocks that oppose your bullish order blocks as well. So if I mark these bearish order blocks in red, and then your bullish order blocks could stay grey. Look here, in this sole segment in price, you had a number of bullish and bearish order blocks. So that poses the question, which one is likely going to hold and which one is likely going to give way? And that is where the first key point comes into play. The first key point in identifying high probability and low probability order blocks is always your higher time frame directions, right? Here, the weekly, printing higher highs, higher lows, higher highs, higher lows, higher high, before it gives you a lower low. So if I go back to here, this lower low was created after you had this market structure break over here. So this is your market reversal to go from bullish to bearish. As that's the case, if you drop down to daily, you can see that from here to here. Look at the number of bearish order blocks that were getting respected and bullish order blocks that were getting disrespected. Starting all the way from over here, right? Notice how this overall leg, it had a number of bullish candles. And I mentioned, when you have a number of consecutive bullish candles, you can use the entire range as your bearish order block, because on the higher time frame, that's just one big bearish order block. But because of how large the range is, me personally, I would refine it to either 2 or 1 bullish up candles. Remember, this segment in price was where you had your higher time frame market reversal to continue bearish. So you had this first initial bearish order block. Price drops lower, it retraces back into this bearish order block. This bearish order block was validated after it had a full body closure past the open of this up candle. So that's your first high probability bearish order block. Price retraces and drops lower. You can see here, another up candle before the drop lower. This is another bearish order block. And you can see price accumulates here, right? Before it mitigates this bearish order block, accumulates more positions to go short, because remember, your higher time frame direction is now bearish, before it gives you another drop lower. So now we are focusing on this segment in price over here. This consolidation range, look at what is created. This is where up candles were created before the move lower. So here, this is another high probability bearish order block. However, if you look at this over consolidation range, these two up candles are the one that's larger, and it's essentially indulging these small two up candles. Right, so that means what you can do in this scenario is use the two larger bullish up candles, because remember, these two large bullish up candles are also valid for your bearish order block, because it's the last up candles before the general move lower. This wick above here, even though it went higher, it was simply just a sweep on these buy side liquidity before dropping lower. So there was no body closure past the swing high. So this overall price action over here still can be considered as your movement lower. So these two up candles are your last up candles before the general movement lower. So that means you could use that as your overall bearish order block. But it's entirely up to you. You could use this or refine it to these small ones over here. Me personally, I would use these ones because that is where price retraces back into. But essentially, both of them follow the same criteria. They are both high probability bearish order blocks because it follows your higher time frame direction. And as you can see here, price comes back before it just continues dropping lower. Now, in the drop lower, even though we have been focusing on your bearish order blocks, look at the bullish order blocks that gets created. Here, you had your last down candles before the move higher. Even though it doesn't have a full body closure past the swing high, this is still a valid bullish order block. The reason being is because there's a full body closure past the open of these consecutive bearish candles. So here, this is also a bullish order block, but you can see how price trades through it with little to no resistance after it swept this buy side liquidity. That is why these bullish order blocks are low probability, because it is not in line with your higher time frame bearish directions. Vice versa, if you was in a bullish direction on the higher time frame. On your lower time frame, bullish order blocks should stay respected and bearish order blocks should be disrespected. Another thing to note here is, even though bullish order blocks could appear in this higher time frame bearish scenario, you can see that it doesn't appear as often in comparison to your bearish order blocks. So that is another sign to note in determining which type of order block, whether it's bearish or bullish, are the ones that are dominating the opposing order blocks. So that's your first key point in determining high probability order block. It's very simple. Which direction is price currently going in? Your second key point in identifying high probability order blocks is when that certain order block sweeps some form of liquidity. So here, if you look at these two order blocks, yeah, right, price swept that swing high in the form of your buy side liquidity in the process of tapping into this bearish order block. In fact, you have another one over here. So a swing high gets created, your first and third candle has a lower upper wick compared to your middle candle's upper wick. So as the middle candle's upper wick is the highest, this becomes your swing high. And this is where buy side liquidity resides. You can see here that when this large up candle was created, price moves higher, sweeps this buy side liquidity before dropping lower. So when this last up candle got validated after price trades through the open of that candle, this creates your high probability bearish order block. Because before the move lower, it has swept out significant buy side liquidity. So this high pretty much becomes your high resistance liquidity. Hence why this bearish order block becomes high probability, because you are not anticipating for price to trade through this high. So this overall bearish market structure should stay respected. This is your second scenario. Price trades higher, takes out these resting trendline liquidity or this swing high before it drops lower. In the process of doing so, your last up candles, they become your bearish order block. Again, this becomes your high resistance liquidity. One thing I forgot to mention here is, when marking out your order blocks, it's entirely subjective and up to you whether you want to include the wick or just the body. Both of them are the correct ways to mark your order blocks. It's just down to you on whether you want to refine to the bodies or include the entire wick. But for me personally, I like to use the bodies, hence why in all of these examples you can see me using the bodies of the order blocks. But here, last up candles swept buy side liquidity before continuing lower. so creates high resistance liquidity, and the validation of the open of these large up candles are three confluences that solidifies your bearish direction. Hence why bearish order blocks should continue to stay respected, because up candles are supporting price to go lower in a bearish scenario, and down candles are supporting price to go higher in a bullish scenario. And again, your last example here, suits buy side liquidity. The last three up candles, remember they are consecutive, so you can use the entire range. They become your high probability bearish order blocks. If you look at this bullish scenario over here, it's the same thing. Here, before price continues higher, it sweeps liquidity in the form of sell side liquidity, and it displaces higher. Here, your last down candle becomes your bullish order block. When it trades past the open of this large down candle, that validates your bullish order block. This bullish order block swept sell side liquidity, so that makes it even higher probability. This swing low should ideally stay protected. And you can see price comes back to exactly this bullish order block. The body is closed within the bullish order block before it continues higher. And you get another scenario here. Get another sweep on the sell side liquidity before price continues higher. So your last down candle before the move higher becomes your bullish order block. Price retraces, respects that, and it continues to go higher. If you look at this scenario, it's another example, right? This up candle swept this buy side liquidity. In hindsight, this is when you had your market reversal. So this is your large up candle. If you extend it out, because it swept buy side liquidity, this means there is potential for this bullish candle to become a high probability bearish order block. The reason why I said there's potential is because at this point in time, the open of this up candle, the open of the large up candle before the general move lower, it hasn't been traded through with a full body closure. You can see how these two candles, the body respected the open of this large up candle. So that means this doesn't validate this order block yet. It's only when price has a full body closure, such as this down candle, past the open of this bullish up candle, is when your bearish order block gets validated. So you can see here, this becomes your high probability bearish order block now, because it's swept to buy side liquidity and it has a full body closure past the open. Here, this up candle retraces back into this general area of your bearish order block. And that is where you had your movement lower. Now that brings me on to my third key point in high probability order blocks now. Look at the ones that hold, such as here. These bullish up candles are holding. If you drop onto the higher time frame, what do you notice here? You have these key higher time frame levels, right, in the form of your discount rates or premium rates. In this specific scenario, you had an old low, the price sweeps. So these bullish up candles are currently holding itself to support price to go higher. Your high probability order blocks are always formed off of your higher time frame key levels, whether they're premium or discount rates. In this scenario, remember, when it's old low, price sweeps that old low, and these down candles are supporting price to go higher. So because these down candles are formed at a higher time frame key level, this is what makes it a high probability. Because every key level, whether they're premium or discount, you will always anticipate some sort of a reaction away from it. And because that reaction on the higher time frame is a much more significant move, that means on your lower time frame, any order blocks that is in line with the reaction of your higher time frame key level are the ones that are likely going to hold, because they become your high probability order blocks. Here, there's a high time frame imbalance, right? On the lower time frame, because you had this market reversal here on your higher time frame, price comes back, rebalances this old inefficiency. On the higher time frame, you're already anticipating for this key level to ideally hold to support price to go lower. Premium rates should be respected, discount rates should be disrespected. As that's the case, this means when price comes back into this imbalance and you drop down onto your lower time frame, when bearish order blocks form, ideally it should stay respected to support price to go lower and take out this higher time frame discount array in the form of your old low. This becomes your next strong liquidity in line with your higher time frame direction. Hence why when order blocks form off of key levels, they are always the most high probability order blocks. And if you remember, I mentioned that every key level you're anticipating some sort of a reaction. So even though it's not in line with your high time frame direction, when price takes out an opposing PD array, such as this old low, you could anticipate some sort of a reaction. And because you're anticipating some sort of a reaction, this is where when you drop down to your lower time frame, bullish order blocks should ideally hold, because they become high probability after taking out your opposing higher time frame key level. But this scenario over here isn't as high probability as this scenario. The reason being is because this is in line with your higher time frame direction. This scenario over here is just opposing your higher time frame direction. You would just plain the anticipated pullback for price to come back into an order efficiency, for example, before continuing lower. So that is why that is the third key point. High probability order blocks are always formed off of your higher time frame levels. So if we have a look at this bearish price action here, utilizing all of our key points now, higher time frame direction, higher time frame key level and liquidity sweeps, let's start to hunt for our high probability order blocks. Here you have this volume imbalance. Price comes back into that volume imbalance, drop down onto your lower time frame. Remember, your higher time frame direction is still heavily bearish. Discount arrays are being disrespected, premium arrays are being respected. So this should ideally be your next draw on liquidity. This is your immediate draw on liquidity over here. So you would anticipate for discount arrays disrespected before price continues lower. Because this is a higher time frame array, on a daily time frame, this is where your high probability bearish order blocks should ideally fall. And that's exactly what you get over here. This now becomes your high probability bearish order block because it has a full body closure past the open. You can see how after you have that full body closure past the open, price retraces with a small wick back into its bearish order block, accumulates more short positions before distributing it lower. You can see that this is another high probability bearish order block that gets formed, because these two last up candles swept this swing high in the form of the buy side liquidity before it continues lower. So that was your second key point in determining high probability order blocks, right? And as you can see, it continues to drop lower. If you look here, we have this imbalance now. This is where we can anticipate for price to have a reaction off of to continue with your high time frame bearish direction, because it hasn't shown any signs of a market reversal yet. Can you come back to here? Or this bearish order block over here. Drop down to low time frame. You can see that these last up candles become your bearish order block, and it continues lower. If you want to look at it in more detail, look at your previous high probability bearish order block. Remember this one that had a sweep on buy side liquidity? Sweeps that buy side liquidity, continues lower. So this becomes your high probability bearish order block. Even though this was still a high time frame level, if you refine it, price actually came back to this bearish order block before it gives you a drop lower. So because these last up candles before the move lower was formed off of your high time frame weekly imbalance, this is what makes it high probability as well. And you can see that when price validated these up candles to create your bearish order block, price retraces and respects the overall range of this bearish order block before it continues lower. Yeah, you have another scenario. Sweeps that high, last up candles, high probability. It doesn't necessarily retrace, but price continues to go lower. So up candles are consistently supporting price to continue lower. So that is pretty much it for this video on high probability order blocks. It's a fairly simple video. Despite order blocks appearing everywhere within the markets, it's extremely easy to identify which ones are likely going to hold and which ones are likely going to give way. And that is pretty much it. So if you guys found this video helpful, please like and subscribe. If you have any questions or suggestions for future videos, please leave them below in the comments. And like always, take care, and I'll see you guys in the next one.